This past week, gold surpassed $4,000 an ounce for the first time, which raises the question, what are we to make of this historic development? Hi, I'm Todd, and I've had the good fortune to live the American dream and watch that dream become a reality for many other people. These podcasts and my free Substack newsletter are my way of passing on some of what I've learned along the way. After a short break, we'll discuss gold's recent surge and what it might be telling us about the economy. Commenting on gold as an investment, Warren Buffett once observed, "I have no views as to where it will be, but the one thing I can tell you is it won't do anything between now and then except look at you." Buffett's remarks highlight gold as a speculative investment as opposed to other productive investments like companies that make goods and services people want and or need, and by growing their sales and earnings over time, steadily increase in value as they make ever greater contributions to our economic well-being. So then, what are we to make of Gold 4000? While, as Buffett suggested, gold is a speculative investment, this doesn't mean gold prices have no meaning. In fact, the precious metal has long been associated with monetary policy. So let's take a look at gold's historic relationship to money so that we can more fully understand what to make of Gold 4000. Prior to the 1800s, European countries found themselves in something of a monetary doom loop. They would go to war, run up large budget deficits, and then print money to fund the deficit spending as well as taking on borrowings. Now, the money printing devalued their currencies, which means that those who lent money to the governments were being repaid later with currency that had lost purchasing power. Realizing that this could eventually completely destroy their ability to borrow, Great Britain led the world on to what became the classical gold standard, which was so successful in helping increase trade, economic growth, and fiscal reliability that most of the major economies in the world joined the gold standard over the course of the 19th century. While the U.S. operated without a central bank during the 19th century, it nevertheless operated under a gold standard system as well. And as a result, with the primary exception of the Civil War, there was little to no overall inflation, and the price of gold increased only nominally, from $19.39 an ounce in 1800 to a little under $21 in 1930. Not coincidentally, the lack of a central bank, the resulting lack of inflation, and the overall limited government ethos of this era resulted in perhaps the greatest period of sustained economic growth, successfully absorbed immigration, and upward mobility in history. Now, unfortunately, during World War I, in the early part of the 20th century, Europe reverted to its historic and disastrous pre-gold standard history and engaged in excessive deficit spending to help fund the war. This deficit spending destroyed the underpinnings of the classical gold standard system. And after a decade of equally disastrous policy responses that only delayed the final day of reckoning, the international monetary system collapsed in the early 1930s. This forced the U.S. to devalue the dollar to $35 an ounce of gold, where, with some modest variations, it more or less remained until Lyndon Baines Johnson, LBJ's, spending on Vietnam and the Great Society programs in the late 1960s. Just as central banks have throughout history, the Fed cranked up the printing presses to help finance LBJ's deficit spending. Chronic deficits and the Fed's money printing then forced Nixon to abandon what was the post-World War II Bretton Woods gold standard system in 1971. Once the gold standard was abandoned, the Fed was more or less free to print money, and the results were not pretty. The Fed's inflation during the 1970s eventually pushed the price of gold up from around $35 an ounce in the late 60s to more than $600 an ounce in 1980. Again, not coincidentally, these chronic deficits and the inflationary money printing from the Fed resulted in one of the worst economic decades in our nation's history. Interest rates soared, unemployment increased, and investment returns on stocks and bonds suffered. The run-up in gold that accompanied these deficits, inflation, and economic stagnation of this era provides something of a canary in the gold mine for where we are today. But before we get there, let's first take a look at the period of sound money that temporarily brought things back under control and reinvigorated economic growth from the 80s to the 2000s. In the 1980s, Ronald Reagan finally gave then Fed Chair Paul Volcker the political backing needed to shut down the Fed's printing presses. The results were spectacular. Inflation came down, interest rates dropped, and the economy took off. In the 1990s, Bill Clinton inherited a booming economy and the peace dividend from ending the Cold War. And, to his credit, he added a healthy dose of fiscal responsibility to the mix. By 2000, federal budgets were in balance, and the price of gold had fallen all the way back down below $300 an ounce. But then, after the tech stock bubble collapsed in 2000, the Fed again reverted to its historic ways. It pushed interest rates to historic lows to try and preempt the economic consequences of the tech stock bubble collapse. As I show in my book, these misguided policies drove the acceleration phase of the housing bubble, which then collapsed in 2007 and led us into the great financial crisis of 2008. Even though the economy had fully recovered within months after Barack Obama took office in 2009, his administration nevertheless engaged in historic peacetime deficit spending to try and jumpstart the economy, and the Fed again returned to the printing presses, which pushed the price of gold up to over $1,700 in 2012. Keep in mind, it had been below $3,000 at the beginning of the 2000s. After moderating for a period, deficit spending spiked again during COVID in 2020. And even though the economy had already recovered by the time Biden took office, during his first 2 years, it continued to spike. I'm talking about deficit spending. Now, abetted by the Fed's easy money policies, gold prices started to rise again, growing from just under $1,500 an ounce before COVID in 2019 to over $2,600 in 2024. Now let's take one more short break, and then we'll come back to discuss what Gold 4000 is telling us today. So far in 2025, gold prices have spiked by over 50%, pushing above $4,000 for the first time in history. Now let's consider this rise from three perspectives, beginning with investors. As a speculative investment, it's not possible to value the precious metal, gold, in the way we do other income-generating assets. Hence, anyone buying gold is effectively making two assumptions. A, they're assuming that general conditions, such as deficits and inflation, are likely to continue worsening. And B, they're also assuming that these expectations of continued worsening conditions are not yet fully expressed in the current price of gold. Remember, markets are designed to not just reflect where things are now, but also anticipate the future. This is what investors do when they make investments or bets on something like gold. So the net result of this is it's possible to make an informed prediction about whether general conditions will continue to deteriorate. For example, somebody might reason, I believe deficits will remain high and the Fed will revert to its past practice of monetizing these deficits, which will lead to increasing inflation. Nevertheless, even though we can make rational predictions about general conditions, because we cannot calculate an intrinsic value for gold, we're basically forced to operate on a hunch about whether current gold prices already adequately reflect these expectations. In other words, investing in gold is a bit like betting on a handicapped sporting event, i.e., for example, let's say, I'm willing to bet that A, the underdog Cowboys will lose to the Packers this weekend, and B, they will lose by more than the professional odds makers' point spread. Okay, now let's take a look at gold as a prediction market. The characteristics I've just described are basically those associated with a prediction market, i.e., a place where people put down money to bet on a future outcome. Seeing gold in this way allows us to focus on the first element of gold prices, i.e., as a reflection of what market participants betting with their own money think about the future, without having to worry about the second element, i.e., whether the current price of gold adequately reflects how bad things are likely to become. In addition, this speculative element of the gold market, where prices are primarily driven by speculative bets about future conditions, makes it a better measure of inflationary expectations than other markets like the bond market, where investment decisions are also driven largely by asset allocation models, relative yields compared to other investments, and other factors that drive intrinsic value. So gold, while speculative as an investment, does have meaningful things to tell us about what market investors betting their own money are thinking about future conditions. So, do current prices represent a canary in the gold mine? Given the historic relationship between gold and monetary policy that we talked about earlier, and the recent price run-up, the gold market is effectively telling us that there is increasing speculation that deficits are likely to remain high or even become worse, that the Fed is likely to monetize these deficits, and that the result will be rising levels of inflation. Furthermore, these expectations are consistent with A, the failure of the Big Beautiful Bill to address the government's spending problems, B, the Fed's recent rate cut in the midst of persistent above-target inflation, and C, the fear that the government shutdown will lead to an extension of what were supposed to be temporary COVID-related healthcare subsidies, which will further exacerbate the deficit problems. In other words, the gold markets are expressing a lack of confidence in Washington's willingness to deal with the deficits that the current administration inherited. If inflation does increase again, it will negatively impact already high asset values, which will crimp spending, which will in turn hurt job creation, and all of which will create potential headwinds for the administration to deal with. And if the Fed does indeed revert to the printing presses, It will only add to a long line of central bank failures that dates back centuries, as we talked about earlier. In other words, both the president and the Fed chair should heed what the $4,000 canary in the gold mine is trying to tell them. Today, we face important challenges, but none that are greater than those we have overcome time and again throughout our storied history. Here's hoping that your day is as bright as America's future. I'm Todd. Thanks for your interest. If you found this helpful, please subscribe and at least recommend it to one other person. If you'd like to learn more and to find links to my free On Wealth and Progress newsletter and my book, please visit my website, toddsheetswriter.com. Thanks again.